Something extraordinary is happening in the precious metals market right now, and if you own gold or silver, or you've been thinking about it, the next 24 hours could determine whether you're positioned correctly for what's coming. I'm not talking about normal market movements. I'm talking about a convergence of forces that happens maybe once or twice in a generation. Let me show you what I'm seeing. Gold just smashed through $4,400 per ounce. Silver hit all-time record highs. And here's what makes this different from every other rally you've seen. This isn't speculation driving prices. This isn't retail investors piling in. This is something much bigger, much more structural, and frankly, much more concerning for anyone who isn't paying attention. Central banks around the world are buying gold at the fastest pace in modern history, not slowing down, not taking profits, accelerating. The People's Bank of China, the Reserve Bank of India, the Central Bank of Turkey, they're accumulating thousands of tons, and they're doing it quietly, consistently, month after month. Why would central banks, the institutions that print money, that control monetary policy, that have access to every economic indicator you can imagine, why would they be converting their reserves into physical gold at record levels? Because they know something. They see something in the system that makes them uncomfortable holding paper assets. And when the people who print the money start trading it for hard assets, you need to pay attention. But here's where it gets really interesting. This isn't just about central banks. Look at what's happening in the physical market. Silver has risen 138% year to date, not 13%, not 38%, 138%. And it's not because of investment demand alone. There's a supply deficit, an actual physical shortage developing in the market. Silver is consumed in industrial applications, solar panels, electronics, electric vehicles, 5G infrastructure. All of these technologies require silver, and they require a lot of it. Unlike gold, which gets recycled and stored, silver gets used up. It disappears into products that end up in landfills, and global production isn't keeping up with demand. Think about what that means. You have industrial demand increasing, you have investment demand increasing, and you have supply that's constrained. That's not a recipe for a normal correction. That's a setup for a price explosion. Now, let me take you inside the mechanics of what's actually happening in these markets, because this is where most people miss the real story. The COMEX, the commodity exchange in New York where gold and silver futures are traded, operates on a fractional reserve system. For every ounce of physical metal in the vaults, there are multiple paper claims on that metal. It's similar to how banks operate. They don't keep all your deposits in cash. They lend most of it out, keeping just a fraction in reserve. This works fine as long as everyone doesn't ask for their metal at the same time. But what happens when physical demand surges? What happens when people start standing for delivery instead of just trading paper contracts? We're starting to see stress in the system. Delivery delays. Premium spikes on physical metal versus paper prices. Shortages at major dealers. These are the early warning signs that the paper market and the physical market are starting to diverge. And here's the thing about divergences like this. They don't resolve gradually. They resolve suddenly. One day, the system is functioning normally, and the next day, there's a scramble for physical metal that sends prices vertical. I want to tell you about what happened in 1980 because there are eerie parallels to today. Gold hit $850 an ounce, which adjusted for inflation is over $3,000 in today's dollars. Silver hit $50, and the rally wasn't driven by fundamentals improving gradually. It was driven by a sudden recognition that the dollar was in trouble. Paul Volcker had just taken over the Federal Reserve. Inflation was running at double digits. The public had lost confidence in paper currency, and people rushed into precious metals as a store of value. But here's what most people forget about that period. The rally didn't happen in a straight line. There were violent shakeouts, days where gold would drop $50 or $100, weeks where it looked like the rally was over. And every time, the weak hands got shaken out. The people who were trading on emotion, who didn't understand what was really happening, they sold at the bottom of those corrections. The people who understood the structural forces, the currency debasement, the loss of confidence, the supply constraints, they held through the volatility. And they were rewarded with life-changing gains. Fast forward to today. We're seeing similar dynamics, but the scale is much larger. The amount of currency that's been created since 2008 dwarfs anything that happened in the 1970s. The debt levels, government debt, corporate debt, consumer debt, are at all-time highs relative to GDP, and the geopolitical tensions are arguably more severe. You have the BRICS nations, Brazil, Russia, India, China, South Africa, actively working to create alternatives to the dollar-based system. They're settling trade in their own currencies. They're building payment systems that bypass SWIFT. They're accumulating gold to back these new arrangements. This isn't conspiracy theory. This is official policy. These countries have openly stated their intention to reduce dependence on the dollar, and they're taking concrete steps to make it happen. Now, what does this mean for you? What does this mean for someone who's trying to protect their wealth, preserve their purchasing power, plan for retirement? It means the old playbook might not work anymore. The idea that you can just park your money in bonds and stocks and real estate and be fine, that assumption is being challenged, because all of those assets are priced in dollars. And if the dollar's role in the global system is changing, if confidence in paper currencies is eroding, then you need to think about what holds value in that environment. Gold and silver have been money for 5,000 years. Not because of tradition, not because of superstition, because they have properties that make them ideal for storing value. They're scarce, they're durable, they're divisible, they're recognizable, and most importantly, they can't be printed. When a government needs money, it can print more currency, it can issue more bonds, it can create more digits in a computer system, but it can't create more gold, it can't create more silver. The supply is fixed by geology and mining economics. That's why central banks hold gold. That's why wealthy families have allocated to precious metals for generations. Because when everything else is uncertain, when currencies are being debased, when financial systems are under stress, gold and silver maintain their value. Let me give you a specific example of how this plays out in practice. In 2008, during the financial crisis, gold was around $800 an ounce. People were panicking. The stock market was crashing. Banks were failing. And gold? Gold went on to rally to over $1,900 by 2011. It nearly tripled while everything else was in chaos. But here's what's interesting. The people who bought gold in 2008 weren't buying it because they thought the economy would collapse. They were buying it because they understood that the response to the crisis, massive money printing, zero interest rates, quantitative easing, would debase the currency. And they were right. Now look at where we are today. The response to every crisis since 2008 has been the same. Print more money. COVID crisis? Print trillions. Banking stress? Print more. Recession fears? Print more. The playbook hasn't changed. And the consequences of that playbook are starting to show up in the price of hard assets. Gold at $4,400 isn't expensive. It's a reflection of how much currency has been created. Silver at record highs isn't a bubble. It's a supply-demand imbalance meeting a currency debasement trend. And here's the critical point. We're still early in this cycle. Most people aren't paying attention to precious metals. Most portfolios have zero allocation to gold or silver. Most investors are still fully invested in traditional assets, assuming the system will continue to function as it always has. But the smart money, the central banks, the sovereign wealth funds, the family offices that manage generational wealth, they're positioning differently. They're increasing their gold allocations. They're buying physical metal. They're preparing for a different kind of environment. Now, I want to address something important here, especially if you're thinking about retirement. If you have significant assets in IRAs or 401ks, let's say $100,000 or more, there's a strategy you should know about that most people aren't aware of. You can actually hold physical gold and silver inside a retirement account. It's called a gold IRA, and it allows you to get exposure to precious metals while maintaining the tax advantages of your retirement account. No penalties, no taxable events, just a transfer of assets from paper to physical. I put together a free guide that explains exactly how this works, the rules, the process, the custodians who handle it. It's in the description below. If you're sitting on a substantial retirement account and you're concerned about currency debasement or market volatility, it's worth understanding this option. Just something to consider as you're thinking about how to position your wealth. All right, back to what's happening in the markets right now, because there's another layer to this story that most people miss. The bond market is sending a signal that's impossible to ignore. Real interest rates, that's the yield on bonds minus inflation, are at their highest levels in 18 years. In theory, high real rates should be negative for gold. When you can earn a decent return in bonds after accounting for inflation, gold becomes less attractive because it doesn't pay interest. But gold is rallying anyway. It's hitting record highs despite real rates being elevated. What does that tell you? It tells you that investors don't trust the bond market. They don't believe that bonds will preserve purchasing power over the long term. They're looking at the debt levels, the deficits, the political dysfunction, and they're concluding that bonds are not the safe haven they used to be. This is a profound shift. For decades, bonds were the go-to asset for safety and stability. But when you have government debt exceeding 100% of GDP, when you have deficits running at $2 trillion per year, when you have no political will to address the spending problem, at some point, bond investors start to question whether they'll be paid back in currency that has any purchasing power. And that's when they start looking for alternatives. That's when gold starts to decouple from traditional relationships. That's when you see rallies that don't make sense according to the old models. Let me tell you about what happened in 2011 because it's instructive. Gold hit $900 an ounce in September of that year. The US had just lost its AAA credit rating. Europe was in the middle of a sovereign debt crisis, and investors were fleeing to safety. But then something interesting happened. The crisis seemed to stabilize. Central banks intervened. The ECB pledged to do whatever it takes to save the euro, and gold went into a bear market that lasted for several years. A lot of people who bought gold in 2011 got shaken out during that correction. They thought they had missed the top. They thought the rally was over, and they sold at a loss. But the people who understood the bigger picture, the long-term trend of currency debasement, the structural problems in the financial system, they held on, or they bought more. And now, gold is more than double that 2011 high. The people who stayed patient, who didn't get emotional, who understood what they owned and why they owned it, they've been rewarded. The lesson here is that precious metals are volatile. There will be corrections. There will be periods where it feels like you made a mistake. But if you understand the fundamental case, if you understand why you own gold and silver, then you can hold through the volatility. And right now, the fundamental case is stronger than it's ever been. You have currency creation at unprecedented levels. You have debt that can never be repaid in real terms. You have geopolitical fragmentation and de-dollarization. You have supply constraints in silver. You have central banks accumulating gold. You have real interest rates that should be negative for gold, but gold is rallying anyway. All of these factors are pointing in the same direction, and that direction is higher prices for precious metals. But here's what you need to understand about timing. Markets can stay irrational longer than you can stay solvent. Just because the fundamentals support higher prices doesn't mean prices go up in a straight line. There will be pullbacks. There will be consolidation periods. There will be times when it feels like nothing is happening. The key is to position yourself before the major move happens. Because when these markets really start to move, they move fast. You don't have time to research, to open accounts, to transfer funds. By the time you see the headlines, by the time everyone is talking about it, the easy money has already been made. Think about what happened with silver recently. It went from $30 to over $70 in a matter of months. If you were waiting for confirmation, if you were waiting for the trend to be obvious, you missed most of the move. The people who made money were the ones who positioned early, who understood the supply-demand dynamics before they became mainstream news. And here's the thing about silver specifically. It's more volatile than gold. It's a smaller market, so it takes less capital to move the price. When silver rallies, it tends to rally harder and faster than gold, but it also corrects harder. It's not for the faint of heart. But if you understand the industrial demand story, if you understand the supply deficit, if you understand that silver is both a monetary metal and an industrial commodity, then you understand why silver has the potential for outsized gains. Let me walk you through the supply situation in more detail because this is critical. Global silver production is around 800 million ounces per year. Industrial demand alone is around 600 million ounces. Investment demand adds another 200 million ounces. So you're already at a deficit before you account for any increase in demand. Now, what happens when solar panel production increases? When electric vehicle adoption accelerates? When 5G infrastructure build-out continues? All of these trends require more silver, and there's no substitute for silver in most of these applications. It's the best conductor of electricity. It's the most reflective metal. It has unique properties that make it irreplaceable in many technologies. So you have demand that's structurally increasing and supply that's constrained. Mining companies aren't bringing new supply online fast enough. It takes years to develop a new mine, and at current prices, many deposits aren't economical to mine. This is a classic setup for a supply squeeze. And when supply squeezes happen in commodity markets, prices don't go up 10% or 20%. They go up multiples. They go parabolic until demand is destroyed or new supply comes online. We saw this with palladium a few years ago. It went from $500 to over $3,000 because of a supply deficit driven by automotive demand. Silver has a similar setup, but the market is larger and the applications are more diverse. Now, I want to talk about the psychological aspect of this, because it's just as important as the fundamentals. Most people are not comfortable owning assets that are volatile. They want stability. They want predictability. They want to know that their portfolio value isn't going to swing wildly from day to day. And that's fine for most of your wealth. You should have a core portfolio that's stable and diversified. But you also need to have a portion of your wealth allocated to assets that can protect you in extreme scenarios. Assets that perform when everything else is struggling. Gold and silver are insurance. They're not meant to be your entire portfolio, but they're meant to be a meaningful allocation. 10%, 20%, maybe more depending on your situation and risk tolerance. Because when you need them, when the system is under stress, when currencies are being debased, when confidence is eroding, that's when they prove their value. And here's the thing about insurance. You don't buy it after the fire starts. You buy it before you need it. You pay the premium when things are calm, so you're protected when things get chaotic. Right now, we're in a period where the warning signs are flashing. The fundamentals are aligned. The technical picture is bullish. The institutional behavior is telling. And yet, most people are still not positioned. That's the opportunity. That's the 24-hour window I'm talking about. Not because the world is going to end tomorrow, but because the setup is so compelling, so obvious in hindsight, that you'll wish you had acted when you had the chance. Let me give you one more historical example, and then I'll tie this all together. In 1971, President Nixon closed the gold window. He ended the convertibility of dollars into gold, and gold went from $35 an ounce to over $800 by 1980. That's a 20x return in less than a decade. The people who recognized what was happening, that the dollar had been unmoored from any hard asset backing, that inflation would accelerate, that gold would reassert its role as real money, those people positioned early, and they made generational wealth. We're in a similar moment now. The dollar's role as the global reserve currency is being challenged. The debt levels are unsustainable. The money printing is accelerating, and gold is starting to reflect these realities. But most people won't act. They'll watch from the sidelines. They'll wait for more confirmation. They'll wait for their financial advisor to recommend it. They'll wait until it's safe and comfortable and obvious. And by then, the easy gains will be gone. The price will have already moved. The opportunity will have passed. So here's what you need to do. First, educate yourself. Understand why you're buying precious metals. Understand the fundamental case. Understand the risks and the volatility. Don't buy because someone on the internet told you to. Buy because you've done the research and you understand what you're getting into. Second, decide on your allocation. How much of your portfolio should be in precious metals? That depends on your age, your risk tolerance, your financial situation. But as a general rule, having 10-20% in gold and silver is a reasonable starting point for most people. Third, decide on the form. Do you want physical metal that you hold yourself? Do you want it in a vault? Do you want exposure through ETFs or mining stocks? Each option has pros and cons. Physical metal is the most direct, but it requires storage and security. ETFs are convenient, but you don't own the actual metal. Mining stocks give you leverage to the metal price, but they come with company-specific risks. Fourth, act. Don't overthink it. Don't wait for the perfect entry point. If you believe in the long-term case, if you understand why you're buying, then start building your position. You can always add more on pullbacks, but the important thing is to get started. And finally, be patient. This is not a trade. This is a strategic allocation. You're not trying to time the market. You're positioning for a multi-year trend. There will be volatility. There will be periods where it feels like nothing is happening. But if you stay focused on the fundamentals, if you understand what you own and why you own it, you'll be able to hold through the noise. The 24-hour warning isn't about panic. It's about urgency. It's about recognizing that we're at a unique moment in financial history. The pieces are in place. The fundamentals are aligned. The institutional behavior is confirming. And the price action is starting to reflect these realities. You can choose to act on this information, or you can choose to wait and see. But understand that waiting has a cost. The cost of missing the move. The cost of not being protected when you need it most. The cost of looking back and wishing you had done something when you had the chance. Gold at $4,400 isn't the top. Silver at record highs isn't the end of the rally. These are the early stages of a much larger move, a move driven by forces that are bigger than any individual, any institution, any government. Forces of currency debasement, supply constraints, geopolitical realignment, and loss of confidence in the existing system. The question isn't whether precious metals will go higher. The question is whether you'll be positioned when they do. And that decision needs to be made now, while you still have time, while the opportunity is still in front of you. Don't let this moment pass. Don't be the person who looks back in a year or two and realizes they missed one of the most obvious setups in financial market history. Take action. Educate yourself. Build your position. And protect your wealth while you still can. The 24-hour warning is real. The opportunity is now. What you do with this information is up to you.